Another important part of our due diligence is the legal documentation. And we actually start reviewing that as we're doing our analytical quantitative analysis of the firm. And we spend a lot of time talking to the manager about how they govern their own company, what the splits are on the economics, so that we think that the people are being treated fairly within the firm and that there is a plan for succession. That's important as we assess a manager. In addition to that, we start looking at the documents, because the documents do say a lot about how they're able to manage the money that we're providing them in the form of this fund. What's the geographic restrictions? Are there limits on the amount that they can put into any one company? How do the economics work? When do they get their incentive compensation? When does it kick in, and so forth? So we spend a lot of time on that and on the documents themselves. And after we approve the deal, then we really dig in order to make sure that we're comfortable with those documents before we close. Then we move on to the monitoring, which is a long period of time. These funds can last anywhere from 6, 7 years to 10 or 12 years. And so we have to continue to monitor the performance of the fund. Many times, in fact, most of the time when we commit to a firm, we're a member of their advisory board. So we meet either quarterly or semi-annually, in some cases annually, in order to get an update from the firm. We also receive quarterly statements on the performance of each of the companies, as well as the overall performance of the fund. And we monitor them by speaking with the manager very frequently. We have reason to contact them at least once a quarter, if not more. And so that's a pretty rigorous process of monitoring. And then about every 4 years or so, if the manager is doing well, they'll be raising another fund. And so we're always doing our ongoing monitoring, which is in effect the due diligence for the next fund in many respects. Access to deal flow is very important in private equity, and it differs between primaries, secondaries, and co-investments. But the one similarity that exists is you have to hustle, you have to know a lot of people and use your contacts in order to generate flow, to identify the next really good manager, to be in early with that manager. And then as it relates to the co-investment business, you need to work with your existing general partners, with your private equity firms, and make sure that they understand your capabilities and be in front of them in order to generate that deal flow. As far as secondaries goes, there's a lot you can do by talking with other LPs and identifying transactions that may be formulating, but there's also a significant intermediary community that is utilized in generating secondary investments as well. So we use all of the tools that we have available to us around the globe to make sure that we're originating transactions, and we have a distribution list that receives emails whenever a deal starts to surface, so that anybody who may have some information around that can contribute and make sure that we're not missing any good opportunities. We think that diversification in private equity is very important. And depending on the nature of the client and the mandate that we have, or the commingled fund that we're managing, the diversification characteristics can be different. But generally speaking, we make sure that there's time diversification. So we want to invest in multiple vintages in a given mandate. We also want to diversify by sector. Sometimes those sectors can be target-oriented, sometimes they're limitations. How much exposure do you want in energy? How much exposure do you want in healthcare? And those numbers can move around depending on our view of the macro environment. Then there's also manager diversification. We don't want to have too much exposure to one particular manager, because occasionally things will go the wrong way. There's also diversification by geography that's important. So if we have a global program, commingled fund, or on behalf of a client, we want to make sure that we're diversifying that. We tend to weight it more towards the US, 50% or more, and then the rest is diversified Europe, Asia, and rest of world. But that's important in our overall risk management, is to make sure that there's significant diversification across the portfolio. sometimes even by stage. And by that I mean how much venture capital, how much growth, how much normal buyout, and then special situations. Special situations could include things like mezzanine or distressed investing or perhaps energy. And the buyout sector is relatively highly correlated to the public markets. As you get into some of these other areas, you see less correlation, so it's nice to have some diversification there as well. I think what differentiates Pantheon from other private equity managers, apart from the great team that I think we have, is that we've been in this business for over 30 years. We've been global for the last 25 years in all of the private equity regions, and we have capability globally across primaries, secondaries, and co-investments, as well as recently, in the last several years, infrastructure and real assets. So we bring all of that capability and all of that knowledge and experience to bear for our clients. So if you put all of that together in terms of the experience, the global reach, the capability, and I think a great team, that's what differentiates us.